You're watching your portfolio bleed red. Gold just plunged 8% in 2 sessions. Silver crashed 31% in a single day, marking its worst decline since 1980. Headlines are screaming about the biggest precious metals correction in decades. Your Twitter feed is filled with panic sellers and bears declaring victory. The talking heads on financial television are already writing obituaries for the metals bull market. And you're sitting there wondering, did I just miss the top? Should I be selling everything right now? Or is this actually the buying opportunity I've been waiting for? So hey traders, welcome back to Pressure Point Economics. I'm AG John. Don't forget to subscribe for latest updates on metals. Now let's move to the topic. Here's what nobody's telling you. While everyone's panicking about the crash, something extraordinary just happened in the gold and silver markets. And if you understand what I'm about to show you, you'll realize this correction might be the most bullish setup we've seen in years. Because the data hidden beneath these headlines tells a completely different story than what you're hearing from mainstream analysts. Stay with me, because by the end of this video, you'll know exactly what's happening, why it's happening, and most importantly, what to do about it. Let's start with the facts. On January 30th, 2026, precious metals experienced one of the most violent sell-offs in modern history. Silver futures plummeted 31.4% to settle at $78.53, making it the worst day since March 1980, when the Hunt Brothers silver manipulation scheme collapsed. In dollar terms, this was the single largest daily decline ever recorded for silver. Gold didn't escape either, dropping as much as 8% during overseas trading, falling from record highs above $5,400 per ounce to around $4,900. The crash wiped out approximately $3.4 trillion in notional value from the gold market alone. The trigger? President Trump announced Kevin Warsh as his nominee to lead the Federal Reserve. Now here's where it gets interesting. Warsh has a reputation as a monetary hawk. During his previous tenure at the Fed, he consistently advocated for tighter monetary policy and pushed back against excessive balance sheet expansion. Markets interpreted his nomination as a signal that the Fed might maintain higher interest rates for longer and potentially accelerate quantitative tightening. The immediate reaction was predictable. The dollar index surged, treasury yields adjusted, and precious metals, which thrive in low-rate environments, got absolutely hammered. But let's dig deeper, because surface-level analysis is exactly what separates retail investors from the professionals who actually make money. The mainstream narrative is simple. Higher rates are bad for gold and silver. Therefore, this correction signals the end of the bull market. Case closed, right? Wrong. This is where understanding market mechanics becomes your competitive advantage. First, let's talk about what actually happened technically. Gold delivered what analysts call a 50% Fibonacci retracement at $49.38 per ounce. If you're not familiar with technical analysis, here's what you need to know. A 50% retracement in a bull market is not only normal, it's healthy. It's the market's way of shaking out weak hands, resetting overstretched indicators, and setting up the next leg higher. The fact that gold found support almost exactly at this technical level suggests institutional algorithms and smart money were waiting with buy orders. Silver's crash, while more dramatic, tells an even more interesting story. The white metal had gone parabolic in the weeks leading up to the crash, surging past $121 per ounce. It gained over 60% in January alone. When you see that kind of vertical move in any asset, a violent correction isn't just likely, it's mathematically inevitable. The question isn't whether a pullback will happen, but when. And here's the contrarian insight. The fact that we got this correction now, early in the cycle, is actually bullish for the long-term trajectory. Now, let's address the elephant in the room. How do we know this is just a correction and not the start of a bear market? This is where we need to separate emotion from data. Bear markets and precious metals share certain characteristics: deteriorating fundamentals, weakening physical demand, collapsing central bank buying, and most importantly, a fundamental shift in the macroeconomic environment that eliminates the original bull thesis. So let's examine each of these factors. Central bank gold purchases in 2025 totaled 863 tons, reaching the upper end of expected ranges according to the World Gold Council. This represents the continuation of a historic buying spree that started in 2022. Central banks are now purchasing approximately 60 tons of gold per month, more than triple the pre-2022 pace. Gold has overtaken the euro as the second largest reserve asset globally, trailing only the US dollar. Consensus estimates show central banks will continue purchasing around 800 tons through 2026, equivalent to 26% of annual mine output. Does that sound like institutions preparing for a bear market? Or does it sound like the world's most sophisticated financial players systematically accumulating before the next major move higher? Let's talk about supply and demand fundamentals, because this is where the story gets really interesting. The silver market is running a structural deficit. Industrial demand for silver, particularly from the solar panel industry, increased 23% year over year. Meanwhile, production from top miners fell 4% due to declining ore grades in Mexico and Peru. COMEX silver inventories dropped to 285 million ounces, the lowest level since 2015. When you have declining supply, surging industrial demand, and growing investment demand all converging, short-term price volatility doesn't change the fundamental equation. Gold's supply situation is equally compelling. Mine production has essentially plateaued while global demand continues accelerating. JP Morgan forecasts central bank and investor demand for gold will average 585 tons per quarter in 2026. That's not including retail investor demand, which tends to surge during corrections like we just experienced. Remember, the smart money buys when others are panicking. Now let's address the Kevin Warsh factor, because this is where most analysts are getting the story completely wrong. Yes, Warsh has hawkish credentials. Yes, he's likely to maintain a more restrictive monetary stance than markets might have hoped. But here's what everyone's missing. His appointment actually reinforces the long-term bull case for precious metals. How? Because Warsh's hawkishness isn't about sustaining high real interest rates forever. It's about maintaining Fed credibility and ensuring the central bank has ammunition for the next crisis. And when that next crisis hits, whether it's a debt ceiling showdown, a recession, or a financial market dislocation, the Fed will ease aggressively. That's when gold and silver typically make their biggest moves. Think about the 2008 financial crisis. The Fed raised rates right before everything collapsed. Then they slashed rates to zero and launched quantitative easing. Gold subsequently quadrupled. Or consider 2018, when the Fed was hiking rates and reducing its balance sheet. Markets threw a tantrum, the Fed reversed course, and gold rallied from $1,200 to over $2,000. The pattern is clear. Monetary tightening late in a cycle sets up the most explosive precious metals rallies when policy inevitably reverses. Here's another angle that's completely absent from mainstream coverage. The correction we just witnessed was heavily influenced by forced liquidation in the futures markets. The CME Group, which operates the COMEX Futures Exchange, raised margin requirements on silver contracts multiple times as prices surged. When margin requirements increase, leveraged speculators are forced to either post additional collateral or liquidate positions. This creates a cascading effect where selling begets more selling, driving prices far below fair value in a short period. This is a technical, liquidity-driven event, not a fundamental repricing. In fact, former JP Morgan strategist Marko Kolanovic predicted silver could crash 50% from peak levels, calling the rally unsustainable speculation. But here's what that analysis misses. Physical silver demand remains robust, industrial consumption continues growing, and the supply deficit persists. Futures market volatility and physical market fundamentals are two different things. Smart investors understand the difference and position accordingly. Let's talk about historical precedent, because markets rhyme even if they don't repeat exactly. In 1979 and 80, gold and silver experienced multiple violent corrections on their way to generational peaks. Gold fell 23% in a single month during the 1979 rally before ultimately doubling again. Silver crashed 45% over 3 weeks in late 1979, then proceeded to make new highs months later before the final blow-off top. The point isn't that we'll see identical patterns, but that brutal corrections within secular bull markets are normal, not anomalous. More recently, look at gold's behavior in 2019 through 2020. Gold rallied from $1,200 to $1,700, corrected 20%, then rallied to over $2,000. Each correction felt like the end at the time, each correction shook out weak hands, and each correction set up the next leg higher for those patient enough to see the bigger picture. Now let's get tactical. What should you actually do right now? This is where we move from analysis to actionable strategy. The worst thing you can do in a correction is make emotional decisions. The second worst thing is to do nothing when opportunity presents itself. So here's a framework for thinking about position sizing and risk management. First, understand your time horizon. If you're trading precious metals on leverage trying to catch every swing, this correction was probably painful and you might be questioning everything. But if you're building a long-term position as insurance against monetary instability, currency debasement, and geopolitical uncertainty, this correction is exactly what you should be hoping for. It's giving you a second chance to accumulate at prices you thought you'd never see again. Second, dollar cost averaging is your friend in volatile markets. Instead of trying to time the exact bottom, which is impossible, commit to accumulating a fixed dollar amount at regular intervals. This smooths out volatility and removes emotion from the equation. Whether gold is at $5,000 or $4,800, you're building a position systematically. Third, understand the difference between trading and investing. Trading requires precision timing, risk management stops, and constant monitoring. Investing requires patience, conviction, and the ability to ignore short-term noise. Most people lose money in precious metals because they approach a long-term investment with a trader's mindset. They buy near tops because of FOMO, then panic sell near bottoms when everyone's afraid. Don't be most people. Fourth, context matters for allocation. Precious metals should be a component of a diversified portfolio, not your entire net worth. A 5 to 15% allocation to gold and silver provides meaningful insurance without creating undue concentration risk. If this correction has your portfolio allocation below your target range, it's a buying opportunity. If it's still above target, let it ride. Now let's talk about price targets, because everyone wants to know where we're headed. Goldman Sachs recently updated their forecast, targeting $5,400 for gold by the end of 2026. UBS sees gold reaching $5,900 following the U.S. midterm elections. JP Morgan expects prices pushing towards $6,000 longer term. These aren't fringe predictions from permabulls. These are research departments at the world's largest financial institutions analyzing supply and demand fundamentals, central bank behavior, and macroeconomic trends. For silver, Citibank upgraded their short-term forecast to $150 per ounce from $100 previously. Bank of America sees silver averaging $56 in 2026 with potential peaks around $65. Even after the recent correction, most analytical frameworks suggest silver remains undervalued relative to gold, industrial demand growth, and supply constraints. But here's what's more important than any specific price target: the trend. Since 2018, gold has been in a confirmed uptrend, making higher highs and higher lows. That trend remains intact even after this correction. Silver broke out of a multi-year consolidation pattern in late 2025 and, despite the recent volatility, has not violated key support levels that would signal a trend reversal. As long as the uptrend structure remains intact, corrections are opportunities, not warnings. Let's address some of the bearish arguments, because intellectual honesty requires considering contrary views. Bears will point out that real interest rates, while lower than peak levels, could remain elevated if Warsh pursues a hawkish policy path. Higher real rates do create headwinds for non-yielding assets like gold. That's factually correct, but it ignores three crucial factors. First, regardless of Fed policy, negative real rates remain the reality in much of the developed world. Second, gold has rallied during periods of rising rates before, when other risk factors like geopolitical uncertainty or currency instability dominate. Third, the Fed's ability to maintain restrictive policy is constrained by record government debt levels. At some point, fiscal dynamics will force monetary accommodation. Bears also argue that profit-taking after such a strong rally is rational investor behavior, implying further selling pressure ahead. Again, this has an element of truth, but it confuses trading dynamics with investing fundamentals. Yes, momentum traders and speculators will continue taking profits, but that selling is being absorbed by central banks, institutional investors, and sophisticated wealth managers building long-term positions. The quality of buyers at these levels matters more than the quantity of sellers. The comparison to the 1980 silver crash is another bearish talking point. The argument goes that silver's recent parabolic move mirrors the Hunt brothers' manipulation, and the outcome will be similarly disastrous. This analogy is superficial at best. The Hunt brothers were attempting to corner a market using massive leverage in a coordinated manipulation scheme that ultimately failed when exchanges changed margin rules specifically to target their positions. Today's silver rally is driven by legitimate supply deficits, industrial demand growth, and investment flows. The two situations share surface-level similarities but fundamentally different underlying dynamics. Here's what I'm watching to distinguish between a healthy correction and something more serious. First, physical demand indicators. If we see jewelry demand collapse, coin sales plummet, and ETF outflows accelerate, that would suggest weakening conviction from end buyers. But so far, we're seeing the opposite. Physical demand remains robust, particularly in Asian markets. Coin dealers are reporting strong sales during the dip. ETF holdings, while volatile, haven't seen sustained outflows that would signal a fundamental shift. Second, central bank behavior. If major central banks stopped accumulating or worse, began selling gold reserves, that would be a significant red flag. But there's zero evidence of this happening. In fact, central banks are likely using this correction to accelerate purchases, though we won't see official data for several months given reporting lags. Third, technical support levels. Gold has key support in the $4,800 to $4,900 range, which corresponds to both Fibonacci retracement levels and previous resistance turn support. If gold breaks decisively below $4,700 and continues declining with increasing momentum, that would suggest more than just a correction. But as of now, the technical structure remains constructive. Fourth, the gold-silver ratio. This ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, spiked during the correction as silver fell harder than gold. The ratio moved from around 54 to 1 before the crash to over 60 to 1 at the lows. Historically, spikes in this ratio during corrections reverse sharply as silver catches up on the next rally phase. Watch for the ratio to compress back below 55 to 1 as confirmation that silver's relative strength is returning. Now let's talk about the bigger picture, because ultimately, precious metals aren't just about trading or even investing. They're about understanding the monetary system we're operating within. Global debt levels have reached unprecedented levels. The U.S. federal debt exceeds $36 trillion. Combined government, corporate, and household debt globally exceeds $300 trillion. This debt cannot be repaid in real terms. It will either be defaulted on, restructured, or inflated away. Each of those outcomes is bullish for hard assets like gold and silver. Currency debasement isn't a conspiracy theory, it's stated policy. Central banks explicitly target 2% inflation, which means they're actively trying to reduce the purchasing power of your currency by half every 35 years. That's the best case scenario. When you factor in actual inflation, not the manipulated government statistics, currency debasement happens much faster. Gold and silver aren't going up in value. They're maintaining purchasing power while currencies decline. Geopolitical instability continues escalating. Trade tensions, regional conflicts, and great power competition create an environment where safety and portability of wealth matter. Throughout history, when empires fall and currencies collapse, gold and silver retain value because they're no one's liability. They don't require trust in governments or financial institutions. In an era where trust in institutions is declining globally, that matters more than most people realize. The energy transition provides another structural tailwind, particularly for silver. Solar panels, electric vehicles, and advanced electronics all require significant silver content. As the world electrifies and attempts to transition away from fossil fuels, silver consumption from industrial applications will only increase. This isn't speculative demand that can disappear, it's structural demand driven by multi-decade megatrends. Let me share what sophisticated investors are actually doing right now, because this is where you can learn from those who've navigated these cycles before. They're not panicking, they're not checking prices every hour, they're systematically accumulating physical metal, particularly silver, at prices that look absurdly cheap compared to where we'll be 12 to 18 months from now. They understand that volatility is the price you pay for asymmetric returns. They know that the worst day to sell is when everyone's selling, and the best time to buy is when it feels uncomfortable. They're also diversifying their precious metals exposure. Physical bullion for the portion you never plan to sell, ETFs for liquidity and ease of trading, mining stocks for leveraged exposure to metal prices, royalty companies for income and lower operational risk. Each vehicle serves a different purpose in a comprehensive precious metals strategy. Here's a key insight most people miss. Your goal shouldn't be to maximize returns on your precious metals holdings. Your goal should be to preserve purchasing power and provide insurance against monetary chaos while participating in upside when it occurs. If you approach gold and silver as a get-rich-quick trade, you'll get shaken out in corrections like we just experienced. If you approach them as essential portfolio insurance that occasionally delivers spectacular returns, you'll have the conviction to hold through volatility. So where does this leave us? Is this correction a healthy consolidation or the start of a bear market? Based on everything we've analyzed, the evidence overwhelmingly supports the consolidation thesis. The fundamental drivers remain intact. Supply and demand dynamics favor higher prices. Central banks continue accumulating. Technical support levels are holding. Historical precedent suggests corrections of this magnitude are normal within secular bull markets. And perhaps most importantly, the macroeconomic backdrop of unsustainable debt, currency debasement, and geopolitical instability hasn't changed. The correction we witnessed wasn't a warning signal, it was a gift. It was the market giving latecomers and underallocated investors another chance to build positions before the next leg higher. It was weak hands transferring their metal to strong hands at discounted prices. It was a classic shakeout designed to make you doubt your conviction exactly when you should be most confident. Here's what I'm doing personally. I'm viewing this correction as an opportunity, not a threat. I'm using systematic dollar cost averaging to accumulate both gold and silver, with particular focus on silver, given its more extreme correction and better long-term fundamentals. I'm being patient, understanding that bottoms are processes, not single-day events. I'm ignoring short-term noise and focusing on the multi-year trend. And I'm preparing mentally for the possibility that we could see even more volatility before the next sustained rally begins. Because here's the reality that separates successful precious metals investors from everyone else. You will never buy at the exact bottom and sell at the exact top. Trying to do so is a fool's errand that will cost you money and sanity. What you can do is build positions when the risk-reward is favorable, maintain those positions through volatility, and allow the long-term trend to work in your favor. That's not sexy. It doesn't make for good social media content, but it works. The metals bull market didn't end on January 30th. It paused, consolidated, and shook out weak hands. The same fundamental forces that drove gold from $1,200 to over $5,400 remain in place. The same supply deficits that pushed silver from $14 to over $120 haven't disappeared. What changed is sentiment, positioning, and short-term momentum. Those things reverse quickly. Fundamentals don't. So ask yourself, when you look back 12 months from now, will you regret that you panicked during this correction, or will you be glad you had the courage and conviction to see through the noise? Your answer to that question will likely determine your precious metals returns over the next cycle. Choose wisely. The opportunity is here. The question is whether you'll recognize it before it's gone.